Welcome to Talk Tickers, your shortcut to getting up to speed on the latest earnings call.
Glad to be here.
Today, we're doing a deep dive into Allison Transmission's second quarter 2025 earnings call. It just happened yesterday, August 4th, after the market closed.
Right. And our goal, as always, is to really break down what was said, the numbers, the strategy, what management's thinking, so you get the full picture.
Exactly. We want to distill all those key insights for you. So let's jump right in with the top-line results. Allison put up some really strong numbers for Q2.
They certainly did. Diluted EPS, earnings per share, came in at $2.21.
And that wasn't just a small beat. It was comfortably above the consensus estimate, which is around $2.21. That sends a pretty strong signal about how they're running things.
Definitely. And revenue was solid, too, $814 million. That also beat the consensus, which was closer to $803.7 million.
But, you know, what really jumped out at me was the margin expansion. That was impressive.
Absolutely. Gross profit hit $402 million. That translates to a 49.4% margin.
Wow, nearly 50%. And that's up 110 basis points year over year.
That's right. A 1.1 percentage point improvement compared to last year. Significant gain there.
Yeah, for a company this size, improving growth margin by over 1% really says something about pricing or cost control, or maybe both.
And it wasn't just gross margin. Adjusted EBITDA, another key profitability metric, was $313 million. That's a 38.5% margin.
Also up year over year, right? By 160 basis points.
Exactly. 1.6 percentage points better. Shows they're converting those sales into core operating profit very efficiently.
Net income looked healthy too, up 4% year over year to $195 million. And adjusted free cash flow, always important, was $153 million.
So across the board, really solid numbers, a beat on the key metrics. And the market reaction seemed, well, measured. A slight positive move after hours.
Yeah, maybe quiet confidence, not huge fireworks, but definitely acknowledging the good results.
Okay, so that's the snapshot, but we need to go deeper, right? Peel back the layers on what's actually driving this.
For sure, because total net sales were actually flat compared to last year. So beneath that flat surface, there must have been some big shifts between segments.
There absolutely were. The real standout, I think, was the defense end market.
You're not kidding. Sales there surged. What was it, 47% year over year?
47%. Yeah, huge jump. That really highlights how strong their position is in that, pretty resilient sector. It's a great counterbalance to other areas.
Definitely. And what else was strong?
Outside North America, on highway sales, they hit a record, actually. $142 million, up 11%.
Driven by South America and Europe, the call mentioned. Shows that geographic diversity is paying off.
It does. And then you had service parts, support equipment, and the other category. That was also up about 6%.
Right. Higher demand for parts, maybe older trucks needing more maintenance, plus some strategic price increases helping there.
Exactly. So those strong areas, defense, international on-highway parts, they did a good job offsetting the weaker spots.
Which were?
Global off-highway, that was down quite a bit, 30%. And the North America on-highway market, down 9%.
So yeah, definitely a mixed bag. A tale of two markets, almost. Some segments firing on all cylinders, others facing real headwinds.
Precisely. And looking at profitability again, that gross profit increase, management said it was mainly driven by those price increases you mentioned.
So pricing power was key, enough to overcome lower volumes in those weaker segments and even some unfavorable raw material costs?
That's what they indicated, yeah, which is pretty strong execution. Net income also got a boost from that higher gross profit.
And didn't they mention something about unrealized gains on securities?
Mm-hmm. Mark-to-market adjustments on their investments. Basically, the value of some investments went up on paper, which flows through to net income.
Okay. And this was despite higher SG&A costs. Selling, general, and administrative.
Right. SG&A was up, and that included about $15 million in costs tied to that pending Dana acquisition we need to talk about.
We definitely do. And that record quarterly EPS, the $2.29, driven by the higher net income, but also fewer shares outstanding, right? Buybacks helping there.
Yep. Share count reduction gives EPS a little extra boost. Cash flow from operations looked good, too, $184 million.
Which was up mostly because they needed less cash tied up in working capital, plus that higher gross profit flowing through.
And they finished the quarter in a really strong liquidity position. Tons of cash on hand, $778 million, plus access to more credit.
And that leverage ratio, net debt to EBITDA you mentioned earlier,
came in at 1.38 times. Very healthy.
So what does that 1.38x ratio really tell us, practically speaking, about their flexibility?
It tells us they have a lot of dry powder, Their debt level is really quite low relative to their earnings power. It means they can comfortably fund growth, maybe more M&A like Dana, invest in R&D, and still weather any economic bumps without stressing the balance sheet. It's a sign of real financial strength.
Good context. Okay, so let's pivot to that strategy and what management was saying. Beyond the numbers, what was the big message?
Well, they definitely highlighted their resilience in defense, as we saw in the numbers, and kept emphasizing their pricing discipline. Clearly, that's working.
But what about looking forward? Innovation, new products.
They touched on that. Announced their 3000 series transmission is now available in Mack Granite trucks powered by CNG, compressed natural gas.
So expanding options for vocational trucks, adapting to different fuel types.
Exactly. And their AGN Flex hybrid system got picked for buses in Baltimore. So pushing into sustainable transport solutions, too.
And more on the defense side.
Yeah, a new order for transmissions for Poland's new infantry fighting vehicle.
It seems like they're really leaning into that defense strength.
For sure. And maybe even more significantly for the future, they got awarded Phase 2 of a big U.S. Army contract for their next-gen electrified transmission, the EGM Force.
So targeting future platforms, things like the OMFV, the optionally manned fighting vehicle.
Right, and potentially future main battle tanks globally. So they're not just relying on current defense contracts, they're positioning for the next wave, including electrification in military vehicles.
Very strategic. But the elephant in the room on the call was definitely the Dana deal, right? Buying their off-highway business for, what, $2.7 billion?
Absolutely. That was a huge focus. It feels like a really pivotal moment for Allison.
How so? How does it change things for them?
Well, it adds hydromechanical transmissions to their lineup, something they don't really have now. It brings in about $700 million in annual revenue, and it significantly expands their reach, especially geographically, into construction and mining markets.
So less reliance on their traditional on-highway truck markets, diversification.
Big-time diversification. It's moving them beyond just defending their core business into actively growing through acquisition into new related heavy-duty sectors.
And they talked about synergies, cost savings.
Oh, yeah. They're targeting $120 million in annual run rate synergies. That's the goal once everything's fully integrated.
Run rate meaning the expected savings per year, eventually.
Exactly. They expect to get there within about 4 years, mostly from combining operations, better purchasing power, engineering efficiencies, cutting some overhead.
And they expect the deal to add to earnings pretty quickly.
Yeah, accretive in the first year after closing, which is planned for late Q4 this year, 2025. That's usually a good sign for shareholders.
So how are they paying for this nearly $3 billion deal? And what does it mean for things like buybacks?
They reiterated their capital allocation policy. First priority is funding internal growth, new products. Then, for this deal, they'll use cash on hand plus new debt.
Okay. And they have a target for leverage after the deal closes.
Yeah, aiming for around 2 times net leverage in the near term, which is higher than the current 1.38x, but still manageable for an industrial company, especially with their cash flow.
Interesting, though, despite planning this huge deal, they still bought back over $100 million in stock during Q2.
They did. Opportunistically, they said. It does signal confidence in their own share price, doesn't it?
It does. But they did say buybacks are paused now until the Dana deal is done.
Correct. They're pausing buybacks for now, focusing on closing the acquisition and managing the debt. But it sounds like buybacks are still part of the long-term plan once they hit their leverage targets again. It shows discipline, I think.
Makes sense. All right, let's shift to the outlook. Guidance for the full year 2025. They updated it.
No, they did. Basically tightened the ranges for everything. Net sales now expected between $3.075 billion and $3.175 billion.
Net income, $640 to $680 million. Adjusted EBITDA, $1.12 to $1.18 billion. And adjusted free cash flow, $620 to $660 million.
Right. So the midpoint for sales came down a little bit.
But interestingly, the midpoint for the implied adjusted EBITDA margin stayed the same. How does that work? Lower sales, but same profit margin percentage.
Good question. The main reason they lowered the sales guidance is that softening in the North America on-highway market we mentioned. Truck makers, the OEMs, are seeing weaker demand, higher dealer inventories.
So they're cutting back production, layoffs, shift reductions, longer summer shutdowns.
Exactly. That directly impacts Allison's sales into that segment. It's a clear headwind right now.
But why wouldn't that hurt margins too?
Management's view is, 1, this is a deferral of demand, not a permanent loss. They expect it to come back.
Yeah.
And 2, they're offsetting the volume impact with continued strong pricing and good performance in other areas like defense and international.
So they believe the underlying profitability is holding up, even if near-term sales are softer in one key market. That deferral idea is interesting. Is there a risk it's more than just a deferral?
There's always a risk the cycle could be longer or deeper than expected. But Allison's point is that these are essential vehicles, trucks, buses, military equipment. The need doesn't just vanish. Fleets still age, infrastructure needs support, defense requires readiness. So they're pretty confident demand gets pushed out, not destroyed.
Okay, I get that logic.
Yeah.
Anything else major on the outlook?
Yeah, a couple of things. They expect a nice boost to their cash taxes this year thanks to that One Big Beautiful Bill Act.
Ah, related to R&D tax credits, right? How much?
Mid-double-digit millions in savings they projected, so tens of millions. That's a helpful, unexpected tailwind.
Definitely helps the cash flow.
And they reiterated that pricing discipline remains strong, over 400 basis points of positive impact in Q2 alone, and they expect that to keep helping offset volume softness in the second half.
Plus, limited tariff exposure because they source a lot within North America and ways to manage steel and aluminum costs.
Right. Defense is expected to get even stronger in the second half. Aftermarket parts business is holding stable. Older fleets still need fixing.
And crucially, they don't need major product changes to meet current or upcoming EPA emissions rules. That avoids big compliance costs.
Exactly. So if you kind of connect all these dots for, the investor listening, Allison's delivering really impressive margins, that 49% gross, 38.5% adjusted EBITDA, that's top tier among industrial companies, shows real discipline.
And the Dana deal feels like the big strategic story here, doesn't it?
Absolutely. It signals a real shift. For years, maybe Allison was seen as playing defense, protecting margins in its core markets. Now, with Dana and their push into electrification like EG and Flex and EG and Force,
It looks more like a growth strategy.
yeah,
Growth through M&A, expanding into new areas, embracing electrification.
precisely. It could potentially change how the market views the company, moving it from maybe a steady, reliable value industrial stock towards more of a cash compounder with clearer growth paths.
But the market's reaction was pretty muted, you said. So investors aren't fully buying into that transformation story yet.
It seems like a show-me situation. The results were good, but the market might be waiting for more concrete proof. Like seeing the Dana deal actually close, seeing those synergies start to materialize before fully pricing in that more ambitious growth narrative.
Okay, so what are the key things to watch for then? The catalysts that could unlock that potential re-rating. What should you, the listener, keep an eye on?
Well, number one is the Dana deal closing, expected late Q4. And then seeing the roadmap for achieving those $120 million in synergies, that's critical.
What else?
There's a potential big Department of Defense contract award for tactical vehicles, possibly in early 2026. That could be significant for the defense segment. Also, how quickly does that infrastructure bill funding start flowing to transit agencies? That could boost their bus business. Keep an eye on their Analyst Day in November. They'll likely give updated 2025 guidance then.
And maybe the return of buybacks.
Yeah, potentially reinstating the share buyback program once they get leverage down after the Dana deal closes. That would be another positive signal.
So if they execute on Dana, hit those synergy targets, keep converting cash flow strongly, and maybe get a couple of those catalysts to break their way.
Then you could definitely see the stock re-rating higher, maybe closer to what other drivetrain peers trade at. Could mean significant upside looking out into 2026.
Which, of course, leads to the question, how much of that is baked in now, and how much relies on perfect execution? Always the challenge for investors.
Exactly. Makes it a fascinating story to follow.
All right, and that brings us to our segment called This Is Not Financial Advice. Time for some outrageous, yet maybe plausible, trade ideas based on the call.
And let's be crystal clear. This is purely for informational and entertainment purposes. We are absolutely not financial advisors. Do your own research. Talk to a professional before ever making any investment decision. Seriously.
Couldn't say it better myself. Okay, disclaimer delivered. Idea number one.
Let's call it the $200 dream long position. Management, on call, actually said they believe Allison stock could be north of $200 a share within 3 years.
Wow, that's ambitious, given where it is now.
Very. So an outrageous but plausible trade. Just take them at their word. Establish a long position in the stock itself. Maybe, if you're really aggressive, pair it with some long-dated, way out-of-the-money call options.
Like what kind of options?
Think strikes above $150, maybe expiring in 2027 or 2028. You'd be betting on that long-term cash compounding, the Dana integration working perfectly, maybe some multiple expansion as the market buys into the growth story. A real long-term leverage play on management's vision.
Okay, that's definitely playing the long game. What's idea number two? More short-term.
Yeah, let's call this one catalyst-driven volatility spike. We noticed something interesting in the options market data after the earnings call.
Oh, yeah. What was that?
The August 15th expiration, $135 strike calls, saw the biggest implied volatility spike across basically all U.S. single stocks that day.
Meaning traders were suddenly paying a lot more for those specific, short-term, very out-of-the-money calls. Signals unusual speculative interest.
Exactly. So a plausible but definitely aggressive trade could be to actually buy those calls or similar ones. You'd be betting on some unexpected near-term news.
Like what?
Maybe that DoD tactical vehicle contract gets announced way earlier than expected. Or maybe there's a super positive update on the Dana deal before the Q4 close, something that causes a sudden, sharp upward move in the stock, making those volatile calls pay off quickly. It's a pure gamble on a near-term catalyst.
Got it. Two very different ideas. One long-term vision bet, one short-term volatility gamble. Both definitely provocative.
And again, highly speculative. Do your homework.
Absolutely. Okay, let's recap this deep dive. Allison Transmission put up a solid Q2 beat. Execution looks strong, especially in defense and on pricing.
The pending Dana acquisition is the big story. It's a transformative strategic shift, aiming to move Allison towards growth through M&A and electrification, potentially changing the investment narrative from value to cash compounding growth.
But there are headwinds, especially in the North American truck market right now, so they need to navigate that softness.
They do, but they seem well-positioned with diverse markets, strong margins, and several key catalysts on the horizon. The Dana close, defense contracts, infrastructure spending that could unlock more value and potentially lead to that re-rating we talked about.
As always, remember this conversation is just for informational purposes. It is definitely not investment advice.
So as you think about Allison's strategy and outlook, here's something to chew on. How much risk is there that the softness in North American trucks isn't just a temporary deferral? If that headwind persists longer, how might it impact their ability to execute on the ambitious growth plans tied to the Dana integration?
What part of Allison's story resonates most with you? Something to reflect on.